All right. So after Thursday's market, with rates having one of their single best days this year, are rates about to start a reversal after 9 months, 10 months of going up and actually start working their way down? Well, I think so. And actually, if you've been looking or listening to any of my YouTube videos or been in any of the classes I've done through Web and Learns or in office and stuff where we talk about the market and what's causing rates to go up, you'll know that I've been saying all along that we're going to have a difficult time with the interest rates until we got through December's or October's inflation reports. And the reason for that is inflation has been the key component behind why rates are going up. And so until inflation starts to come down, we're going to have problems with rates. So I'm going to show you a chart. And this is a chart actually that I've been updating throughout all this year. This is a little bit more recent one here, but I've been updating it. But what you'll notice here is I've been saying that inflation, again, the way inflation works is it's a 12-month rolling cycle. So every month we get the prior month's inflation reading, and then we drop off the old one. And based on that, you get this new average over the last 12 months to get your year-over-year inflation. And what you'll see here, for example, back in August, we had gotten a 0.6 reading on inflation, but throughout the summer, which is what I was saying, we had problems because July, August, and September were really low numbers that were going to be really hard to come in at or below, which would cause inflation. And so we got a 0.6 reading here in August and saw a huge jump. Also in September and October, when we got the September readings, it came out also at 0.6, changing this 0.3, and September was one of the worst months for interest rates that I've ever seen. And we had a loss of 400 basis points in a single month, which basically means whatever rate you were looking at on the 1st of September, you're going to pay about 4% of the loan amount higher fee at the end of December. So $100,000 loan amount, you're going to pay $4,000 more for that rate at the end of the month than you were at the beginning of the month. So here's where we're looking, but you'll notice as we get into the past October, we have high readings through here. So let's just take a look now and see what happened yesterday. So November 10th, we got some inflation, inflation numbers out, and look what we got. Initially, we were hoping about a 0.5. We went from a 0.6 down to a 0.3. So this is way better than the market expected. And as a result, you saw the core inflation reading come down the year-over-year basis here, and the stock market had a great day. Interest rates had a great day. So looking forward again, if we continue to see these lower numbers like 0.3, we're replacing these higher numbers, we should see the inflation reading continue to come down. I think there's a strong likelihood of this, and I'm going to look at one component of what makes the inflation number on this report and how I think that component next month or the next 2 months or so could help us even more. So let's just take a look at that. So here's the CPI that we just got out, the Consumer Price Index measuring inflation. Now there's two types of inflation numbers we look at. There's the headline, it's kind of the all-in, and that represented about a 0.4% month over month increase, or inflation reading was just 0.3 something. That gave us a year over year going from 8.2% down to 7.7%. So we saw a drop in the rate. Still seeing inflation. It's not going backwards. Don't be confused by that, but it's going backwards now at a slower rate than it was before. Now the core rate, that's the ones the Feds like to pay attention to. And the reason for that is the core rate strips out food and energy. The Fed's policy and how they use the Fed's fund rate to manipulate the markets and stuff and their ability to buy or sell certain things doesn't really impact food prices and energy prices because those are done on more of a global level. Regardless of what the US is wanting to do, OPEC decides what they want to release, and that has a major impact on our oil here in the US. The war with Russia and Ukraine likewise has an impact on food. So they want to strip out these volatile things where they don't have control over so they can focus on the things they do have control over and then make policies to make that adjustment. So that's why they like the core. So now we saw drops everywhere. We look at all the different components in these here, except for shelter. So let's take a look here at shelter. What we'll see here is shelter actually went up 6.9% year over year. So we saw a really high increase in shelter. And so this is a couple of things I want to kind of point out here. One, with rent and housing at 0.7 and 0.8% year over year, continuing to rise, this shows us that I think there's still a strong underlying demand with there's a real inventory issue. So even though we're seeing appreciation slow, the cost of housing with higher prices, higher interest rates, the cost of rents going up is still causing the housing component to be very high. But there's this other part of housing component that is kind of crazy. A lot of people don't really think about, but it's called the lodging away from home. And what that is it actually looks at the cost for people to stay away from home. So you're traveling, you're having to stay in places, hotels and stuff. That's a cost, a part of the cost of our economy. That was up 4.9%, and that was extremely high. Had this been more in line with the rest of the report, we would saw a much better drop. We already had a great drop, don't get me wrong, it was a great drop, but we would saw even more of a drop in inflation. And this is a really volatile one, so I want to take a look here. This just shows you that index, the lodging away from home, historically since 2002. You can see how this thing is up and down, just constantly going up and down. And so just a month ago, you know, 2 months ago here, we had these real low readings, but last month we saw a really high spike up here to 7.5. And so I think this has given us a higher than what we would expect to be normal reading on inflation. And I think as we get through the holiday seasons where traveling is less, we have a strong probability of seeing this come down. So with that said, I do think, you know, it's early to tell for sure. We definitely got to get validation from the next several months on where the inflation reports come in and how the U.S. economy is doing. But I do think, as I've been saying all along, that we're probably through the worst of it now. We're probably going to start to see those year-over-year numbers of inflation come down. And as the Fed's policy of trying to slow the economy continues to take effect, I think we can see interest rates continue to go down throughout next year. So if I think rates are going down, does that mean you should wait to purchase a home for a lower rate? Absolutely not. And I want to tell you why. The reason is as I've said several times, we simply don't have much inventory. Right now, you don't have the same, 10 buyers for every listing because rates are high. People are afraid of that, so they've stepped aside from the market. But the demand is still there. It's just quiet right now. As rates start to drop down, we're going to get to that point where everybody, like the person who might think it's better to wait, will start to come into the market. And then I think you'll see home appreciation start to heat up again. So by the time you're waiting for that to happen, you're going to see your home price go up and you're going to have lost the benefit of a lower rate, or in part or in whole because of the higher price. But then you're going to be back in that multiple offer situation where, you know, now sellers are willing to take contingent offers. They're willing to talk about paying closing costs. They're willing to fix things, to do things to make it more accommodating. If rates get down to that magic number where people just start feeling good after having rates in the 8s, and they start coming in at the 5s, you're going to find yourself in that situation again where you're going to have to maybe possibly bid over asking price and just really not be in the position to drive a fair deal. So for that reason, I would say if it's affordable for you today, I would buy today, lock in today's pricing, and then you can lock in the future rate if those rates come down. Now I have to say if, because there's no guarantees. So always make sure you're happy with the rate you got now, just in case. But again, if rates never come down, then today's rates might be the future low rate. But I think we have a strong probability of seeing an improvement in rates. So if you have any questions, feel free to reach out to me. Always happy to talk about this industry. I love it. So just let me know and have a fantastic day. All right. Bye for now.